Ladies and gentlemen, we're talking about the Canadian banks that right now are yielding insanely high dividends. I mean, we're talking upwards of 4 to 5+%. And we're going to break these down as Bank of Nova Scotia just posted earnings, which is going to give us clerical insight into likely what the rest of the banks are going to be posting this week. If that is a conversation you can appreciate, in return, I simply ask that you hit that like button, because Bank of Nova Scotia today, guys, is yielding 5.26%. And banks are banks are banks. God knows you don't want to pick a Lehman Brothers, but I highly doubt the Canadian banks are going anywhere anytime soon, being these kind of monopolistic sector-based companies, though trading down 13.73% this year. I'd argue that these are probably some pretty good buying opportunities for those of you looking to cost average into these kind of investments. But at the end of this video, I'm going to show you an easier way to buy these, taking a little less risk by doing it through indexes. But first and foremost, the interesting data I pulled out of the earning results here. First, retail 90+ days past due loans. This is giving us insight into the delinquency rating of people that are 90 days past on their loans. And it's kind of incredible to think that whether we're talking mortgages, personal loans, credit cards, secured and unsecured line of credits, these numbers have actually been decreasing or holding relatively flat since basically, I'm going to say Q4 of 2020 and Q1 of 2021, kind of coming out of the pandemic, when we saw credit cards hit a delinquency of almost 1%, sitting right now at 0.65%. But across the entire spectrum, the delinquency rating is only 0.15%, which again is much lower than Q1 of 2021 at 0.23%, whereas international sees a higher delinquency rating, which is no surprise. Obviously, some of the countries they operate in, like Latin America, might have a little bit more discrepancies and higher delinquencies, clearly because the total is sitting at 2.34%, but still dramatically lower than the 4%, by almost half as much than Q1 of 2021. Now, from a deposit growth perspective, this is also very intriguing. We saw this in the US with JP Morgan and some of the conglomerates there, but we can see that there is growth in people depositing, right? Because Canada's population is growing. Very few banks to utilize, same in every sector like telecom. There's only a handful of companies to utilize. So we see everyone flooding into these, and we can see that, yeah, there's still 7% growth, in basic banking here, whether it's personal or non-personal, 3% for the personal, 7% for the non-personal growth. So that's pretty good from that perspective of it. Like, all their segments are seeing deposit growth. So that's pretty good. Loan growth by business line. So we have residential mortgages, we've got personal loans, credit cards, and business loans. Again, almost every single one of these segments is seeing growth. So this is pretty good considering the rocky recessionary period that we're sitting in, that they're still seeing growth across every segment of loans and mortgages, right? So just taking a look at the financials themselves here to simplify this as much as possible, taking a look at total revenue, guys, everything mortgages, their interest, their non-interest income was 7.79 billion, a slight increase from 7.75 billion the same time last year. But when we take a look at that net income, guys, a very nominal growth rate from 2.54 billion this time last year to 2.59 billion. So why is this kind of not that great? I mean, a lot of people are looking at this as bad earnings. I noticed they missed on a few estimates, but we can see that they've actually increased over last year their provisions for credit losses. This is money they sock aside to protect themselves, unlike probably the Lehman Brothers did when they over leveraged into real estate. Banks here are very cautious about the kind of recessionary period we sit in, and they just want to protect themselves. So they kind of start stacking money aside just to deal with losses, right? So it's a big part of the reported financial results when we're talking about banks. But all in all, guys, to see still segment growth across the board, the fact that interest rates are going up and we're still seeing mortgage loan, increase, this is all good stuff. This is really good signs that the underlying economy still is not as bad as the media continues to push onto us, right? So taking a look at the other banks, this should give us really good insight that if there's still mortgage growth coming out of Bank of Nova Scotia, that we should still see some nominal growth coming out of Canadian Imperial Bank, which is primarily focused on the residential mortgage market. But we can see that they've declined, paying a 5% yield as it stands today, which is wonderful. All of the valuations, I think, are very fair valued here. This is going to be posting earnings on the 25th. Toronto Dominion Bank, huge exposure to the US here, in one of the best performing banks, and I think the third largest company in Canada at $120 billion market cap, paying 4.15%. Another exciting one to watch, guys, coming up on August 25th. Royal Bank, the largest bank exposure I currently have in Canada through the ETFs we're about to look at, is posting earnings tomorrow morning here, guys, and again, yielding 4%. I mean, these yields are just absolutely absolutely incredible since the recent kind of sell-off since the beginning of the year. But taking a look, guys, I'm going to definitely be paying attention to this one. BMO is another really fascinating one because it has a huge oil exposure. And with that huge oil exposure, we saw a wicked decline in the crash when oil started to kind of, slow down. And obviously having all that oil exposure in loans, people were really pessimistic of this company. And then all of a sudden when oil boomed, this stock came back being one of the best performing banks from the bottom to top, up 104%, but still yielding 4.2% and still having a better PE ratio than a lot of these other banks. I mean, this has been a very intriguing one to watch, and it's posting earnings on August 30th here, guys. So I want to know what banks you're most paying attention to, and are you buying these individually? My family, I personally have a lot of exposure to these banks in the financial sector here in Canada, and lately I've been getting a lot of that financial exposure through a couple ETFs. I'm going to show you two that I really like right now, which is the Ishares Core Msci Canadian Quality Dividend Index ETF. This one primarily focuses on the financials in Canada, and I'm just going to show you the holdings real quick. These are, I believe these are monthly paying. The other one we're going to look at, I'm 100% sure is monthly, but I think both of these are monthly. Don't quote me on that, but taking a look, this ETF's primary exposure is to Manulife, Royal Bank, Bank of Nova Scotia, Sun Life Financial, Toronto Dominion Bank, Fortis, Restaurant Brands International, Rogers, Shaw, Emra. So taking a look at the exposure rating, we can see 50.86% of this ETF is primarily financials, with about a 21% weighting in utilities and an 18% weighting in communications, which honestly, I don't think there's a better exposure to Canada when we're talking about dividend income. Taking a look at the distribution, yes, we were right. It is paid monthly. It's 3.46%, and the expense ratio is very low on this. We can see that the 12-month trailing yield is about 3.84%, and the expense is about 0.1%, so a very, very low expense ratio. The performance of this one isn't nearly as better as the one we're about to look at, but I like that it's equal weighted. A lot of financials, telecom, and utilities, which are probably the best sectors to be exposed to for dividend income. As we can see, the stability in the chart here is very straightforward. It just lacks a little bit of growth, which is why I really like VDY, which has outperformed basically XDIV, which is again the ticker for this stock. But VDY is the Vanguard version. I think this is BlackRock's version of this, but VDY is more or less focused on kind of the top weighted dividend payers, which we'll take a look at here, because this guy, let's scroll all the way down. We can see that Royal Bank makes up 13%, whereas the largest exposures in the BlackRock, again, they're about 10% weighted. So if we just take a look here, guys, we can see that Manulife, Royal Bank, they're around 9.59%, so just under that 10% weighting. Whereas with VDY, it concentrates these stocks because of their market cap weighting. That's kind of what Vanguard does with a lot of their ETFs. They're all based off market cap, and that's how they debate how big of the percentage weighting should be in the portfolio. You see that with the S&P 500 index, VOO from Vanguard. But we can see you get Royal Bank, Toronto Dominion Bank, Enbridge, Bank of Nova Scotia, Bank of Montreal, Canadian Natural Resources, TC Energy, Suncor, BCE. So we can see with this one, we're getting a heavy weighting into these bank stocks. And just taking a look at the sector exposure rating, guys, again, financials make up 53.6%. And unlike, again, XDIV, these are largely held within the banks, a little less of the like the insurance companies like Manulife. And then we can see energy is about 28%, but that's arguably because Enbridge is a huge position in here. And Enbridge, I would say, is more of a utility to the energy sector rather than being a direct energy exposed stock to some degree. I mean, that's debatable, right? And telecommunication is much lower along with utilities. So you can kind of buy both of these and get a really nice spread with a little bit of growth as well. But taking a look at the yield on this guy, let's just take a look at the quick facts here. We can see the expense ratio is a little higher on this one at 0.2%, trailing 12-month dividend yields 3.82%. And again, it is paid monthly. So this one, a little bit of a higher expense ratio, but again, we're seeing a little bit better growth over the long term because of the way it's weighted. Some of these larger cap growth companies, which again, you can argue if Royal Bank's a growth company or not, but these are some of the best Canadian stocks that exist. And I'm really glad that the largest Canadian companies like Royal Bank being the largest stock in Canada also yields a whopping 4%. I wish we could say that about Apple in the US economy, but nonetheless, I'd love to know what you think about all of this in that comment section below, and consider subscribing because I keep up on the Canadian banks moving forward, because banks are banks are banks. And in my opinion, they're like Pokemon cards. You just got to collect them all, but stay cool and stay awesome. And as always, I look forward to catching you in the next one.